Assalamualaikum everyone, we are from Group 1. Let's go through with us on topic short selling.
Short selling, what we have to define by short selling is that it's one of the trade strategy used by investors who speculate as stocks fall. So they want to make profit when the price of securities decline, and that it can be used as a hedge strategy against the downside risk of a long position, or by speculation for traders. It has three types as explained by Bursa, Malaysia: permitted short selling, regulated short selling, and intraday short selling. So how does it work? First, we borrow from a broker and then we sell it in the market for a higher price. Then we wait for the stock to decline in price. Then we buy back again for a lower price. Then we return our borrowed stock. Then we keep the profit for about for buying a lower price than what we sold. So what are the strategies? First, selling a pullback in a downtrend. You just sell it when you see a pullback in a downtrend, and then selling into an active decline, which is similar to selling a pullback in a downtrend. Basically, in a downward movement, you just sell it and then expect the price to go even lower. Then enter within a trading range and wait for a breakdown. You sell when between two prices that you are unsure of where the price is going to be, and then you wait for the price to break down between which is the price below the range that you expect that you sold it at the first place. Then to minimize your risk, you have to hedge. Then you short sell through ETF, exchange traded funds. Then you use stop loss order, which automatically triggers a buy order to close the short position if the stock rises to a predefined level. Then you have to avoid being greedy, which is a highly risky position. You need to be careful and need to analyze your timing.
There will be advantages and disadvantages of short selling.
The first advantage is possibility of high profits. When stocks decline, it allows investors to make a profit, which can sometimes be rapid and substantial. Stocks that are overvalued or in a bubble phase may experience sudden sharp corrections, offering significant profit opportunities to short sellers. Second, little immediate capital needed. By borrowing shares, an investor can initiate a position without the need to own the asset initially. This is advantageous for those who anticipate market downturns but lack substantial funds to directly invest in derivatives like put options. The third advantage is leverage investment possible. Short selling often involves using margin accounts, allowing traders to borrow funds from brokers to amplify their position. This leverage lets traders control larger positions with less capital, boosting potential profit if their predictions are right. So now we move on to the disadvantages of short selling. So the first one, potentially unlimited losses. No limit on losses. Stock price can rise indefinitely, meaning losses can continue to increase. Unpredictable market move. If the market turns against you, losses can become much larger than initially anticipated. Second, margin account necessary. Collateral requirement. You must maintain sufficient funds in your margin account to cover potential losses. Margin calls. If the stock price rises, the broker may demand additional funds to maintain the position. The third disadvantage is margin interest incurred. Interest charges. When you are borrowing a share, it involves paying interest, which increases the cost of holding the position. Long-term expense. The longer the short position is held, the higher the interest payment will accumulate.
In short selling, there will be positive and also negative impact of short selling towards the market. The positive impact of short selling towards the market are increases market liquidity and can help correct overpriced stocks. The negative impact can cause market volatility and risk of market manipulation.
Next is the relevance of short selling in Malaysian market. In Malaysia, the activities of short selling are regulated by Bursa Malaysia and Securities Commission or SC, with the objective to ensure integrity and transparency. To start, investors must borrow the shares before selling them to avoid it from being a naked short selling. From Islamic perspective, the two main Sharia concerns on short selling are loaning shares and also commission or interest paid on the loan. For loaning shares, it will be hard for the borrower to retain what is similar to the things he borrowed, because shares are constantly changing along with not being considered as a valid object for a loan. Next, due to the elements of riba in the repayment of loan, short selling is impermissible in Islam. And to conclude, short selling is a strategy of selling borrowed stock, hoping the price will go down to buy it back for a profit, while also comes with its own risk. Short selling is important to improve market efficiency and helps in price discovery, but must be done ethically. That's all for this topic. Thank you.